Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. Hope everybody is fine and healthy. Our today's lecture is once again about standard deviation, and it's only the continuation of the first lecture where you have learned how to compute the risk. But today I'm just giving you in practically an example of how to compute the risk, right, from a company. For example, if you want to make investment in stock exchange and you select one of the company of your interest, then how you can collect the data of that company and have to compute the risk of the company. Sometimes you try to make investment in a portfolio, means a number of different stocks. So what you can do, you can collect the data of many companies, 4, 3, 4, 5 companies, right? And then you are comparing what company you would like to make investment in. So based on the risk and return, some company may have higher risk and some company may have lower risk. Then accordingly you are making decision, right? So here I'm just working on 2 companies. I'm just going into the internet and collect the data of 2 companies, right? For example, select 2 companies. What 2 companies? Google and Amazon, right? Okay, so come into the internet and write Yahoo, www.yahoo.com, right? Open the Yahoo web page and click on the finance. Here we have finance, right? And then come here. Okay, in this page click on what? Okay, come here. We have here quote lookup. It means you can put a quote here. Each company may have a quote. So just guess the code of the company. If you don't know, you can just search it out in the Google. So for example, we try to find out the Google company. So write G. When you write Google, automatically the name or the code of those companies appear here, right? So I need a Google company, and Google is Alphabet Incorporation. So click on this company and now look here. Okay, this is Google company, and I need historical data. Historical means past data of 1 year, 2, or whatever, right? Okay, come here into the time period and select. If you need a data for last 2 years, 3 or 4, 5 years, whatever number of years you are interested in, just select it here. But I just need the last 1 year. So 2018, okay, 12 and 31st. It's been December 31st 2018 and also December 31st 2019. Okay, I just select the last 1 year data. Okay, done. And then select the frequency. It's mean I need monthly data and apply. Okay, so once the data, okay, we have, this is the data of the last 1 year, okay, starting from January up to December 31st 2019. Okay, what you should do, download. Click on the download here, and the data is downloaded here in Excel file. Okay, now click on the file. Okay, this is the data, right? Now in this data we don't need these 4 columns. Okay, so delete it. I'm just only interested in this column, right? Okay, just copy both of them, both of these 2 columns, copy and move it to a file where you are interested in. Okay, just click and paste. So dear students, this is the data of the Google company. Okay, what do you mean by adjusted close? these are the closing price of the stock of the Google company. For example, if you want to make investment in this company, so at the end of the month, how much will be a price? For example, this one, right? $1,116, right? So these are the closing price of the Google company. What do you mean by adjusted? Means this is adjusted for a dividend. If a company has given a dividend in any particular month, then that is also adjusted here. So this is the data of the Google. Now I also need Amazon data, so come here and just put Amazon in the search. Okay, where that is, okay, just yes, here. When you write AM, automatically here Amazon is coming. So look here, amazon.com, click on this and then select it. Okay, this, look here, Amazon company, in here time period, again December 31st 2018 and December 31st 2019, and done. And frequency is monthly, and then apply. Okay, this is the last 1 year data of the Amazon, and then download. Okay, once the data is downloaded, here again in this slide we do not need all these unnecessary data here, delete them, and also all of them, and also volume. Okay, only I need this column because the data is already there, right? And copy and move it into the slide where you are interested. Okay, here I just need to put it here. Okay, so this is Amazon. Okay, so now what I need to do, I just to find out the return from these stocks. Okay, you remember what was the formula, the function? So equal sign, okay, leave the first cell, right, equal sign, okay, today's, take start the bracket, today's price minus the last month price divided by the last month, right? In this way, if you remember, B4 minus B3 divided by B3 and enter, right? And then drag it down. Okay, you can copy this cell formula here, paste it here, and you can drag it down. Okay, so look here, this is the returns we have computed for a Google company, and these are the return we computed for Amazon companies, right? I hope you got it. Okay, now what are these, right? Returns. Simply, if you remember in the first lecture, we work on MTN company and we computed the return there, and we found the average, which was the R bar and R and whatever. So I'm not just going into that detail here again, so there is no need. I'm just simply using the Excel function, right, the formula, and that is a standard deviation. So if you remember, find out a standard deviation, SD, standard deviation, and also a standard deviation from this return. Okay, equal sign, and write STDEV. Okay, so standard deviation dot P is for population, it's mean this formula, and standard deviation dot S is the second formula. And if you remember, the data we have collected is not a population data. Why? Because it is a sample data, because we have only selected last 1 year data, not complete data or the population data. So that is why you have to select the second formula, standard deviation dot S. In the last lecture, if you remember, we in MTN we assumed, right, that it was a population, so that is why we use this formula. But now the actual situation, if you want to just make investment in any of the company, so for the realistic picture you have to take the correct formula. So standard deviation dot S, and then select the whole data in the range and enter. Okay, so this is the return here. Now find out return of the Amazon company, right, equal sign, same you have to do, standard deviation dot S, and take all the data in the range. Okay, so we found the standard deviation, right? Standard deviation, this is a standard deviation, right, of Amazon and standard deviation of Google. Okay, click on percent here to convert it into percentage and make it 2 decimal, and here also percent and make it 2 decimal. Okay, dear students, what do we mean by these two figures? So this is the risk in this Google stock, and this is the risk in Amazon, right? It means you can say that Amazon is somehow riskier than a Google, or the Google is less risky, right? Somehow less riskier than Amazon. Okay, so if you want to make investment, right, and you are concerned about return and risk, then you can just check which company is more riskier here. It's not much difference, but anyhow the Amazon is more riskier here. Clear? Google is somehow safe, less riskier. So obviously you have to expect higher return here within from this company and somehow lower here in Google company. Okay, I hope you got it. So what is a risk? A risk means a fluctuation. If you remember, I have given you example of fluctuation. For example, if this is our expected return, right? So what is a fluctuation? Okay, this is called fluctuation, right? Sorry, this is called what? Fluctuation. This ups and down. It's mean the up and down in Amazon company is 5.53%, this volatility, right? In the up and down in the Google company, what we mean by this up and down is 4.96. so your return is fluctuated this much, 4.96 in Google and 5.53% in Amazon, right? I hope you got what we mean by today's lecture. You have learned. So this was somehow practical. If you have any question, then you can ask me in group. Okay, wish you good luck. Assalamu alaikum.